Hello and welcome to Help Nobody Told Me. I'm your host, Shannon Johnson, with my partner and co-host here, Jasmine Shapiro.
Hello.
And we are with Sam Sharp of Rate Mortgages. Is that the way we're saying it now?
That is, yes.
Rate Mortgages. Okay.
Apparently spelling guaranteed was very tough for people, so guaranteed rate has now become rate. So.
Thank you to the U.S. educational system.
We're so happy you're here with us today,
Thank
Sam.
you. Thank you for having me. I appreciate it. I really appreciate the opportunity to be here.
I think you give a little different perspective as a lender, which we
It's
really
refreshing,
enjoyed
so.
hearing you speak a couple months ago, and just, talking about interest rates and how it's not the end all, right? I mean, people are stuck on that, but they don't need to be.
You're not wrong. I mean, I think it's very interesting because, which interest rate's interesting. I think it's interesting because the idea is that people focus on the cost of the money and interest rates being higher, people feel like things are expensive. And I don't blame anyone. I mean, at the time of recording this, obviously, things are very expensive, right? Inflation is, although coming down, we don't feel it, I think, because a lot of times people don't realize the difference between deflation and inflation, right? Inflation doesn't mean things are getting cheaper. It just means if inflation cools, it means things are not getting as expensive. They're not becoming more expensive quicker, right? Whereas deflation means prices are going down. So people don't realize that because like, oh, why is it still costing me so much money to go to the grocery store to feed my family and to take care of my pets and the things that we need to do, right? So of course, interest rates, when they're higher, they cost more money and people are afraid of that. And the problem is that people don't take the time to educate themselves on how to understand how interest rates work and what that means when it comes to their money and how to focus on controlling that and controlling their money. So, I've been focusing on ways to help people look at the ways that they can actually pay less interest, right? And not just buying down their interest rate, but talking about ways that they can have an understanding. It was a conversation I had earlier, was talking about when we go in and we look at buying a home, let's say, right? 30-year fixed is the most common mortgage. Over 90% of the mortgages that are open right now are a 30-year fixed loan, right? And when clients come through, they look at the price of the property, how much they're putting down, and then this allows for a monthly payment. And then that's what they focus on, which is good. You should focus on the monthly payment because that's what you feel. It's what you have to spend. But what's interesting is that people don't realize that they can control that interest and the interest rate without actually having to refinance, buy down the interest rate. Because when you're looking at it from a monthly payment, you should absolutely focus it on this. But why accept that this is what the payment is? If you're buying a home and your lender tells you, okay, your monthly payment is $2,347. You say, great, I can afford that, I'm good. It's okay, but what if your payment was $2,400? What if you paid $2,400? And the impact that this has, because mortgages are simple interest. And this means that every time you apply money towards your payment, you recalculate how much of the next payment will go towards your principal or the balance on your loan versus the amount of interest that's being charged. A lot of people don't realize that because your monthly payment doesn't change. Like, okay, well, I put money towards my mortgage, but it's not changing my payment. This isn't doing any good. Right. But when you shift that schedule and now effectively you're paying less interest and more towards your balance, you can control the effective interest rate. So, for example, if someone had I'll use these numbers because they're fresh in my mind from an example I had from a client. If they were buying a $500,000 home, so this was not cheap. They were putting down 5%, first-time home buyers, and their interest rate was 6.75%, which is not a bad interest rate.
No,
right?
It's not.
Nope, but
it's not 2.5, which is what a lot of people are
traditionally
focusing on.
Historically,
right.
6.75, not bad.
That's not bad.
Of course. No, and you're not wrong. When they did their pre-approval, rates were at 6.25. So they were focused on what this was going to cost. They actually wanted to cancel their contract. They were like, this is bad. I don't know about the expenses. Now, I have all of their financial information. I'm very well aware of what their expenses are. And it was not, let's just say it wasn't stressing things. It was half of what the stress would be for qualifying. So I knew it was something else going into it. But the way that the math works and what they didn't understand going into this that I was able to explain was that by applying just a little bit of additional money towards their balance, they could actually effectively lower how much interest they pay, right? So people focus on the interest rate. My interest rate is 6.75%. That's too high. Great. What interest rate would you like to pay? Would you like to pay 6.5%? Now, in their case, $37 extra going towards their balance. And so their monthly payment would be $37 higher, and they would actually reduce the amount of interest paid. That would be the same as paying an interest rate of 6.5%. So by focusing on the monthly payment, you can control the interest rate. A lot of people look at making one extra payment a year. You see this all over social media. I put videos out about this. People talk about it. They say, oh, you can pay your loan off in 23 years. But they fail to talk about why, what's happening, what's the actual behind the scenes, because I think that's the magic, and that's what's happening here. In this and this same example for my clients, it was, again, $475,000 loan amount at 6.75%. By paying, it was just under $3,000 a year, an extra payment every year, they were reducing the amount of interest paid by over $112,000 over the life of the loan. That was the equivalent of having 5.5% on their interest rate.
That's huge.
It's tremendous.
Wow.
It's not a little.
Right.
It's not
That's
a little
a light bulb
bit.
moment.
It's huge.
Yeah, it is. It's an aha moment for people, right?
Yes.
And it doesn't matter. It's people are like, okay, yeah, but you're not paying your loan off in 30 years. You're right. Most people don't. But if you were to look at the payments, the application in 5 years, the amount of interest is the same as you would have paid at 5.5.
And most people are in their homes 5 to 7 years.
They've even gone longer now, up to the average cycle is going from 8 to 10 years.
So we've moved up a little bit.
We have, yeah.
Okay.
And if you want to pay it off, the lender is going to take your money, or
Yes.
the bank, I should say, is
Yeah.
going to take your money.
For sure.
Yeah.
So let's talk about first-time home buyers for a moment,
Yeah.
or someone who hasn't bought a home in 20 years, you know, kind of the same thing, right?
Downsizers.
Right.
What are the key steps that they should be looking at before they even apply for a mortgage?
I think you want to have a good understanding of your budget, understanding your lifestyle, and having very real expectations or real conversations with yourself, if you will, on where you're willing to make those compromises. So I think the first thing that people need to do is you need to, well, get your money in order. You need to know exactly what you're going to be comfortable spending and think of it from a monthly payment perspective. This is how much, if you're paying rent, this is how much I pay in rent, this is how much I'm comfortable paying on a loan. Or maybe you're in a position where you haven't paid a mortgage, you own a home, you're older, and you haven't had to pay a loan for a long time, and now you're looking to go that route. Well, then how much are you going to be comfortable paying every month? So you start there. From there, now we know that it costs a lot of money to actually buy the home, right? You have to put money down for your down payment. You have closing costs. It's very expensive to buy a home. So you go through and have an understanding of what does this mean for your assets. So if you're in a position where your savings, you have money saved, and you have to put down $30,000 and you only have $35,000, well, that's probably not the best idea, really, right? You don't want to have $5,000 in the bank and then you have a $2,500 payment, so that means in 2 months your money's gone if you don't have other income streams. So you want to have an understanding of what your ability is as far as the cost perspective and what that looks like as far as how much money you need to make that happen. And you can do that by talking to a qualified lender. Do your research, talk to a mortgage professional who can help you understand what that looks like. And that's why so many people say you need to get pre-approved first. A lot of times that's confused with, well, you can't even see a property unless you're pre-approved. You can't buy a property unless you're pre-approved. But the reality is that a pre-approval actually sets and helps people understand their budget and their options. So they should start there, so that way they know what the money looks like. And then they need to have that same understanding when it comes to, they meet with their real estate agent and they start to talk to their agents. Know what your non-negotiables are.
Right.
Right.
And Shannon and I talk all the time about, we are very choosy about who we put on our team.
Mm-hmm.
And you really have to have good, knowledgeable people, which is why we invited you here today, because we trust you. And it is really important for our listeners to meet with a loan officer that they trust, so that they can get this information.
And how soon do they need to do that? I'm planning to buy a home sometime this year, maybe in next year.
Mm-hmm.
How soon should I sit down and talk to a loan officer?
Immediately. I think that you can never be too
He didn't hesitate. Did you notice that? It was immediately.
Think about it. How much research is too much research? How much understanding is too much understanding? You should be proactive when you're preparing for your financing so that you have a better understanding, and it can give you Now you have a better gauge on what this looks like a year from now, a year and a half from now. There are also steps that you could make, that'll put you in a better position, because when you qualify for a loan, it's based off your credit, your income, and your down payment. Those three factors not only determine qualifying, but the types of loans that you can get, what the interest rates look like. So let's say it's going to determine what this will cost you. So by doing the research up front, there are things you can do to improve your credit. There's things that you can do from a savings perspective to put yourself in a better place. So that way you're able to have a better understanding of how to control that money, so that when the time comes, you can make a move. So you should start immediately. And we set up, and this is becoming more of an industry standard, we set up all of our loan approvals with a soft pull on your credit. So in the past, people would say, I don't want to pull my credit.
Right.
Because it would hurt their credit score, which I think is the most ridiculous thing in the world. But they don't want to pull their credit because it's going to hurt their score. Well, now we use a soft pull that accesses their actual credit score. So we have your credit score, your actual credit history. We can issue a loan approval. So now by starting a year and a half out, 2 years later, you're not doing anything where it's going to actually hurt your qualifying. It's only going to help you.
Right.
So I think you should
And
be out in front of
Shannon,
it.
you and I have worked with some first-time hopeful home buyers that were renting and weren't sure, do I renew my lease? Am I in a position where I can buy yet? And we always say you need to talk to a lender, because
Right.
let's say they tell you you do need to renew your lease, but here are the steps you need to do so that a year from now you can buy.
Yep.
So it's really never too early, right?
Agreed. No, you want to be prepared so you know how to make that next move when the time's right.
Yeah.
And you pointed out a couple things that I want to circle back on. How does credit score impact your mortgage eligibility, and how can you improve it?
Okay, so that's good. That's a very good question. The easiest way to put it is the higher the credit score, the lower the interest rate. So the stronger your credit, as far as that credit rating goes, the better interest rate you can qualify for. Also, credit depth, how many accounts you have open, and how long those accounts have been open for, will determine the types of loans you may or may not be able to use. So if you're in a position where you don't have any accounts open, you're looking to spend a certain amount of money, well, there's some lending products that you cannot even use because you don't have those accounts open. So having an understanding of how to set your credit up for qualifying purposes is important. And that's also why, let's say if you're looking at doing something 2 years from now, there's steps that we can make. Say, okay, well, this is how we're going to help you get a 12-month, 24-month credit rating and a history that you need for that. Now, as far as improving your credit score, your credit score is a math problem. Okay, it's a math problem that's made up of points that you get points and you lose points, like a video game, right?
Mm-hmm.
You get some points, we're going to lose some points, but it's basically a score on how well you borrow money and give it back. This is your score. So what I'll find people who say, oh well, I don't have any credit, so my credit must be good. I never borrow any money. It's like, well, no, your credit's non-existent, which is not great, because now you can't qualify for some of these other loan programs because you don't even have a credit score. So there are actions within how you manage your credit that will improve your credit. An easy way, just the easiest thing that I recommend to people, is to borrow money. So get a credit card, okay, responsibly. Get a credit card responsibly. It's the number one factor. Don't spend money you don't have. So use the benefits of a credit card to buy gas and food and the things that you need that you're going to spend the money on anyway, and then pay that off every month so that you can show that you're going to borrow the money and you're going to give it back. And keep in mind that if you pay your credit card off every month before you go past the due date, you do not pay interest. So you're not just borrowing money and paying interest on it. You're able to control that. Now you're not only establishing, well, there's benefits, right? You're establishing a better credit score. There's benefits through credit card companies where you get points and other benefits that you can use for other things in your life. Incentives,
absolutely.
exactly. So go through and do that. You have to borrow money to get that score and to get a higher credit score. The higher that credit score is, and the longer your history of showing that you'll borrow money and pay it back, the better chances you have of getting a better loan.
Okay. What loan programs or incentives are available for first-time homebuyers?
Well, there's quite a few. They do change. They come and go with the tides, so to speak, and it can be based off of the availability. If there's money available, some programs come around and then we use all the money. Right now, a very popular program that we have that a lot of people don't know about, there's a Smart Buy program, which actually will allow buyers to they can borrow the money to buy their home, and then they receive up to $40,000 to pay off their student loans.
Oh, wow.
Yeah, this is one of my favorite programs
Wow.
right now. It's amazing. It really is amazing. And it's not for everyone. You have to meet the requirements. They have income. You can't make too much money. They have income requirements and restrictions. You have to pay your loans off in full. So I'll give you a real life example. I have a client who's using this program. They have $46,000 in student loans. They have to bring $6,000 to the closing table because they can only pay off $40,000 in student loans. They also have to keep that loan in place for 3 years. Now, when a lender tells you have to keep a loan in place for 3 years, don't confuse this with a prepayment penalty. But in this case, if you pay the loan off in 3 years, you have to pay the money back. Now, when running through the math problem with their student loans and the amount of interest they'll pay, again, just focusing on how much money is actually
Right.
leaving your account. Fast forward in 3 years, how much will you have in the bank versus how much you have today? It's not even a close comparison. Interest rates could drop to 4% because keep in mind, keeping your loan in place means not refinancing. So they cannot refinance for 3 years. I did the math. Even if rates dropped to 4%, they still would have been ahead by more than double what they're
Wow.
saving by getting rid of those student loans. So that's an example of a program you can use. And these programs vary state through one state to the next, and in some cases even one city or county to the next. The city of Chicago has programs that you can't use in surrounding areas. Some of the suburbs have surrounding programs that are available that you can't use. So that's part of when you're talking with a lender that they're going to determine and have a better understanding of, okay, well, this program, there's a Borrow Smart program that'll allow clients to receive a better interest rate as well as $3,000 to go towards a transaction. Right?
And I think that's
a lot of these.
There's a distinction between a mortgage broker who kind of shops that loan to figure out where are the best programs for this buyer, correct?
Right. You are correct.
As opposed to, I go to my local bank
Mhm.
and they offer me a mortgage.
Yep,
They're just using their bank resources
correct.
for that mortgage.
Mhm.
So there may not be as many options for a buyer. And
You're correct. There are not as many options when you're going directly to your bank. It does not mean there are not good options. So I'm not saying that.
and you trust your bank, you had a
Right.
relationship with them, da 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 da.
They handle your money already, so why would they be the best source for your financing? But the reality is that when you're going to your bank, banks make money off of depository accounts. They make money off of you give them your money so they can lend your money out and make money off of it. That's how they profit. That's one of that's the main focus, right? And when it comes to mortgage lending, a bank will offer programs, incentives. Well, one of the reasons they offer them is to encourage you to use their services and maintain your money because that's where they make their money. They're not making it off of lending. They're making it off of your depository accounts. So the downside to that is not only do you have limited options, but they also don't invest in their own lending infrastructure. It's not where they make the money. So why would they? Why would they invest in a smooth
Right.
process and setting up something where they can actually maintain and make sure that the client has a good experience? And let's face it, everyone wants to check with their bank first, so they don't even have to do a good job, really. They just have to try and provide the service as kind of a second thought, if you will. But you have a mortgage broker, mortgage banker, and banks are your primary sources, and credit unions. Okay, and when you go through and you look at those sources, you'll find your most options are going to come through with either a mortgage broker or a mortgage banker. The difference between the two, mortgage broker is a third party, someone who will shop for loan programs for you, and they will look for the best options. So they're going to say, okay, based on the type of property you're buying, your credit score, how much money you're putting down, I've looked at these different options, and this is the best way to get you the lowest interest rate. So when we say best options, it means it's either we're giving you money for the transaction or you're getting a lower interest rate. A mortgage banker will do the same thing. The only difference is that a mortgage banker is going to have they basically lend their money. This is what my company does. So I can shop for the best loan program, whether it's selling it to a different bank or different state entity. For example, the loan I mentioned earlier, paying off your student loans, is through IDA, which is the Illinois Housing Development Authority. We lend the money and then they basically reimburse us. So that's the gist of it. So mortgage banker means that I can use these different programs, but I use my underwriter, my closer, my funder.
Right.
So I remain in control of the transaction. I can set and control the timeline so that people don't have to worry about maybe running into other problems because someone wasn't doing their job properly. Mortgage bank or a bank is depository institution. You deposit your money. They have checking and savings accounts. And then a credit union is, well, it's very much like a bank, only they're going to follow their own guidelines. It's their money. They'll play by a different set of rules. And sometimes credit unions can have some really good programs as well. They're going to go through and they'll offer incentives to try and help people obtain financing. The downside to credit unions is that, just like a bank, they don't invest in that infrastructure, so they don't have the professionals. There are certain ones, I won't name any names because I don't want to say anything about anyone else, but there are credit unions that they don't actually even have loan officers. We had a client who came to us because they had to make changes to the down payment, and the contact they had at the credit union couldn't tell them how that change was going to impact their loan. They had to wait for the underwriter to underwrite the loan and then tell them what was going to happen.
Oh, God.
Oh, scary.
Yeah. So it was for us, it was very easy to say, okay, this is what's going to happen. This is what they'll do, and we were able to earn that business. But so there are differences between, and I think there are pluses for most of the lending institutions.
Yeah.
So there are a couple things out there. I can go online and I can go to XYZ and I can get a pre-qualified really quick. What's the difference between pre-qualified and pre-approved?
Sure. Pre-qualified means that a lender has most likely reviewed your credit, so in some shape or form, soft pull or hard pull, and they've taken verbal representation of your income and your assets, right? Because loan approval is based off credit, income, assets. So you've told them, I make this amount of money, I have this amount of money in the bank, and here's my credit score, and they say, great, you're pre-qualified, we'll give you a loan.
That's it.
That's it. That's all that's been done.
Verbal.
Right, exactly. So they failed to tell them that they make this amount of money, but they've only been making that amount of money for 2 months, and they started their own business, which means they technically can't actually get a loan. So the pre-qualification's not digging beneath the surface. A lot of people like the convenience of a pre-qualification because they don't have to make a commitment, they don't have to provide documents, and they think that it's valuable. I mean, your agents, right now, no one's accepting a pre-qual. Yeah, that doesn't work. So a pre-approval means that someone has gone through and they've a licensed mortgage officer or a loan officer, a professional has gone through and now reviewed your credit along with your actual income and your assets to determine that you meet the requirements for the loan product, which is closer to what we do. I actually go through and we take a step further and we issue a loan approval, not just a pre-approval. And the loan approval means that I have underwriters who review income, assets, credit, everything up front. They go through and they do all the heavy lifting because things get very stressful once you go under contract to buy a home, right? They're very emotional. People all of a sudden are dealing with terms they haven't heard before, like attorney review period, inspection, AI, what is this? All of a sudden it becomes very stressful.
And time constraints.
And multiple offers.
Multiple offers.
If you don't have a pre-approval,
right.
No.
So
well, speaking of multiple offers, what advice do you have in this market? Because here in Illinois, we are still at low inventory levels,
right.
Although much of the United States has started to creep back up. We're still record low. How do they compete? How can you help them compete?
We use that loan approval because what happens, so by going through and taking care of everything up front, using the time while we have it, this allows us to make a more aggressive offer or stronger offer. So if a client's going to offer on a property, we've already reviewed their income, their assets, I can issue an actual loan approval. And that means that, let's say someone's buying a single family home, that means that the only thing we need is clear title to that home. And then most likely an appraisal, maybe not, depends. Sometimes there are appraisal waivers. So we're in a position right now where that client can come and make an offer on the home on Monday and we can have their financing clear to close by Friday.
That's incredible.
It works really well.
And in this market, that could win an offer.
It does because you're competing with cash offers. So if someone
Right.
comes in and says, I'm a cash buyer, and your client says, well, we're getting a loan, but our loan's done. Well, what a lot of people don't realize is like you think a cash buyer is the best buyer, but they're not. They're kind of a pain because they feel like they hold the cards, right? We get an inspection. Oh, well, we want a discount for this, or we want this because we're paying cash. We're the strongest offer you're going to get. And that can be less pliable than someone who is borrowing the money, is happy to take the steps they need to make a successful transaction and to communicate on more of level playing field, if you will. So by getting that loan approval up front, that's something that can help. I think the second thing that people need to do is make sure they're working with a professional who knows how to communicate.
Mm-hmm.
You want to make sure that that professional knows how to answer the phone, so that way when your clients make an offer on a property and the listing agent's trying to call the lender to find out what steps
Wait, you
they
answer the
took.
phone?
Yeah, I do. Yeah.
Really?
Yes,
It's not like a whole system and I have to push buttons and try to get to a human being?
No, but that would be nice.
No,
Right?
that
Everyone
would not be
loves
nice.
that, don't they? Yeah. And a human being you can't understand. It's just
Right.
terrible.
But Sam, you do also get back to us. Like, I mean,
Right.
let's face it, you could be an appointment or whatever, but you do return phone calls.
Well, I have people who call at
Rare.
the exact same time, right?
Right.
You have to be able to call people back.
Right.
I do.
You're in an appointment, you're at a closing, you're whatever.
I do a lot of training and mentorships for other of my colleagues and people who work at my company, and that's the thing I tell them. I said, if you want to be ahead of 50% of the game, just answer your phone.
Right.
I said, if you can't answer your phone, just make sure you call people back.
Right.
We say the same thing about realtors.
Yeah, I'm playing nice in the sandbox.
Now, you're also licensed in other states, right?
Nationwide, yeah, absolutely.
Yeah.
I can lend in every state.
Which is good for our listeners, because I know we focus a lot about Illinois, but you
Mhm.
can help them all over.
Yeah, well, a lot of people relocate and go to
Yeah.
other states, or they have family in other states, and
Yeah,
it's important.
it is
So-
important.
One thing, before we wrap up that we want to talk about is how can buyers avoid predatory lending, unfair loan terms? What do they need to be looking for? Like, there's some stuff out there that's still happens, although the industry has done a lot to
Mhm.
protect people. What do they need to be looking out for?
Interesting timing on that question, given the state of the CFPB and what might actually happen with those regulations, which is scary because they're necessary. There are, at the time of this recording, layers of protection to help people avoid this, but I think it's like anything. If one of my favorite T-shirts I see is it says, "No one's coming to help you," right? Take control of that situation. This is your money. This is what you're dealing with. We spend how much of our, I don't know the statistic of the amount of time we spend at work to make money. We invest to make money. But yet the one thing that people spend the least time trying to understand is their money. They're afraid of it, which is unfortunate because when you're afraid of it, it controls you. The more you can understand it, the better you can control it. So when you're in a position where you're going to be looking with lenders, how do you do that? Well, it starts with trust. Find professionals that you know that have trusted relationships, right? With, for example, yourselves. You have the experience. You deal with a lot of lenders. It's easy for you to connect someone and say, look, we know that this person is going to look out for you. We know that this person is good at what they do. And that's a good place to start,
Yeah.
right? To be able to talk to someone and say, okay, I know that I've worked with this person. Be careful, because we all know that when someone's going to buy a home and it comes time to get a loan, they're at Jenny just bought a home 2 weeks ago and has a lender who talked to someone whose cousin was a lender, and it starts to go down this trail of diluted trust,
So
if you will.
you deal with the same thing that we do.
I do.
Yeah.
Yeah. It's not just home inspections and
When Dad shows up for the home inspection,
Yeah.
no!
No, it's not. No, I think that you want to work with trusted professionals, with people who have the experience of working with more than just one person, so that way they know they've been through that, they've seen the good, the bad, and the ugly, and they know how to help direct you. So I think one way you can protect yourself is by going through and talking to the professionals. Second way is to do your research and to become familiar with the terms that are used in lending. You want to start to understand, because chances are, and I'm guilty of this all the time, I'm trying to fix it, but we use terms all the time that we think people understand, because it's, for 23 years of doing this, I've used these words every day, so I think people know. You think people know what an appraisal is. Why? Why should they? They don't do
Right.
this all the time. So become familiar with those terms, so that way when you are talking with professionals, you can start to have a better understanding of what that looks like. And then the third thing you can do is shop around. Talk to a few people. Make sure that you have a good understanding of who you feel like you can trust. You feel like they're giving you the information. They're giving you options. They're not just trying to steer you towards one way or the other.
Awesome. Well, we're so glad we got to spend some time with you today and talk through all this buying and mortgage and the stuff that people don't understand going
And
into
there's probably
this.
way
And
more that you could talk about, so we have to have you back.
I would love that. Yes, I can talk for days. I'm never short on
Yes.
talking, as you can
And
probably
things
tell.
change, so we need to have you back to
things
talk about
do
changes.
change, as we all know in this industry.
Well, thank you for the opportunity. I appreciate it.
Absolutely. And we hope you join us again next week on Help Nobody Told Me.